So with this one strategy, you can actually save over $1 million in taxes throughout your retirement. Having all of your investments in pre-tax accounts is a recipe for disaster. What you'll encounter is something that we call the tax bomb, or otherwise known as the RMD trap. This is where you'll be paying more in taxes than you otherwise needed to if you had just done a little bit of planning beforehand. What I'm going to show you today is what those dangers specifically are and how to mitigate them. And because Roth accounts didn't even come out until the late 90s and Roth 401ks didn't come out until about 2006, the majority of retirees I encounter, and probably most of those on this video, have most of their retirement assets in pre-tax accounts. If you don't, that's great. Let people know in the comments that you did it right, okay? But for most that are watching this, that's their situation. I teach personal finance at a Big Ten university and have a wealth management firm. And I recently had someone become a client of my firm because of just this. They realized almost a little bit too late that this tax bomb, it was imminent. It was incoming. Okay. It was being dropped by an F-35 on them. And they had all their investments in these pre-tax accounts. The previous investment advisor was just that. It was an investment only advisor. They didn't warn them about this impending tax disaster. And now that they're a client of mine, we're utilizing many of the strategies that I'll talk about today. It's not just a good disclaimer, but literally every situation is different. But the strategies I talk about should be something that will apply to most people who have this tax bomb risk. And one way or the other, these strategies can help. Whether it helps a lot or a little, it should help. First, really quick, just to catch you up, what are pre-tax accounts? Well, these are retirement accounts that you have received a tax deduction for putting money into them, such as a traditional IRA, traditional 401k, 403b, etc. Anything traditional. You haven't paid taxes on the money yet, but when you take the money out, that's when Uncle Sam gets paid. This is in the form of ordinary income taxes, but you don't need to pay any of the FICA taxes, but it's still taxes nonetheless. And then keep in mind that there is another type of retirement account that uses a tax classification called Roth. This is the prettier stepchild to the traditional IRA. For these retirement accounts, you didn't get a tax benefit when you contributed to it, but it does grow tax-free. And there are no taxes when you withdraw money from it. And lastly, there's a type of account that's not a retirement account at all. That's simply just called a taxable brokerage account. But I like to call that a flex account, since you can put as much money into it as you want and take as much money out of it as you want. But now let's get into the good stuff, avoiding this tax bomb. Let me show you an example client that we will apply these tax saving strategies to. All right, look here. See my little mouse? It's going. This is John and Jane. You can see it up here in the top left. John and Jane, here's their situation. I kept it pretty simple. They're age 62 and they're not going to retire until 67. All right, and that's over here in 2030. And then later we'll get to the tax bomb. So here's their current situation. We're just going to say they have $2 million. It's spread evenly between John's IRA and Mary's IRA. All right. They have a little bit of a CD and then they have a home, primary residence, but that's not included necessarily in their retirement calculations, just from a net worth standpoint. So as you can see, they live pretty modestly, right? They have some expenses. I don't have any taxes in here yet because we're just not getting to that point yet. About $7,000 a month. Okay. So they get into retirement and they're paying some more taxes. That's kind of when the planning starts, right? They have some taxes, but let's get all the way to their RMD age. And so I do think I have a video. I'll put it somewhere on the screen talking about RMDs. But for a lot of those listening, if you haven't started RMDs yet, it will start when you turn 75. Look at the tax portion down here, right here in the bottom left, right? Here's when RMDs start. Look at how much the more they're paying in taxes. They went from paying like 6,000 in taxes that year to 24 grand in taxes. That is the kicker. That's the tax bomb, because all of their assets at that point are still in these pre-tax retirement accounts. And that's a serious problem when the tax bomb hits. What's happening is that they were likely in a pretty low tax bracket leading up to the tax bomb, and then they got moved into a much higher tax bracket. Follow along really quick. I'll just explain tax brackets really quick. Here's a tax report that we use for our clients. This is for John and Jane Smith. Again, these are, this is a fictional name, but these can be really real numbers. And so as you can see, they have their income, but let's just go all the way down. So let's say their total taxable income was 180,000. Let's just go all the way down to the tax brackets, right? So this is how the tax brackets work. Any money in the first bracket is taxed at 10%, right? We see that right there. And then the money in the second bracket is taxed at 12%. And John and Jane, and right now they're ending up in the 22% bracket. You can see it over here. This is where they're at. They're in the 22% bracket. Now, there are some other things to consider, and this will be important later. There is something called IRMA brackets, or these are like the Medicare Part B and D brackets. As you can see, this is where they're at right now. And later in retirement, that can move you up. And as you can see, you have a base premium that you have to pay. And then you add in a certain amount every month. So if you're in the second bracket, you add 74, and then it keeps going. And this is per person. The other thing that's interesting is that this is kind of a cliff. Whereas the moment you go $1 over, now you're paying that whole additional premium. And that does matter, and those dollars add up. It's kind of like a tax, and we can account for that. But the tax bomb, when that hits you with RMDs, that can push you into a much higher IRMA tax bracket than you otherwise would want to get into. The first big strategy that we'll talk about is something called Roth conversions. This is where you are converting some of your assets that are in the pre-tax accounts to Roth accounts early in retirement. And this way you get money out of those pre-tax accounts that are subject to the tax bomb, the RMDs, once you hit your RMD age, typically 75 if you haven't already been taking RMDs. But let's get into it. Let me show you an example of how that works, okay? So come back with me over to their situation. Let's go do some tax analysis, right? See what we can do about this. So this is going to show two examples, a little bit complicated, but just stick with me. This is showing their current tax brackets, right? And this is if they're just taking things out, they're in the 12% all the way until you get to 2038. But let's look at what if we implement one of these strategies, Roth conversions, right? To try and pay more taxes now when it's low before we get hit by these taxes. So let's just use let's say that they do a Roth conversion to fill up the 22% tax bracket, which again, we talked about the tax brackets just a second ago. That's in the blue. So look, they're going to be paying taxes quite a bit up front. And then when the tax rate hits, they're still paying the 22% tax bracket. But later on in life, they're now not paying actually any taxes later in life. And if they were just to go with their normal plan, they'd be paying, in the 24% bracket, which is a lot of money. And the total tax, if we look at that, you can see it's quite a bit. In these early years, if you do the 22% conversion, which we just talked about, you're paying almost 50,000 in taxes. And just really quick, the Roth conversion is where you convert in these years of low taxes some of your money in the traditional pre-tax accounts, you convert them to Roth. So you pay the tax now, and hopefully those Roth monies will grow. Then you don't pay taxes on them later. Now, this is a little bit aggressive. Now, it does save you some money, though. Let's just look really quick at the stats. So doing this Roth conversion strategy right here, filling up the 22% bracket, that could save you over $1 million in this hypothetical simulated example over the course of your retirement and make your net legacy go up by $1.2 million. But as we just talked about with the total tax that you're paying, that's a lot of tax. Paying 50 grand early on instead of 8-9 grand, that's a lot of money. So let's see if there's something better. So what we do then is we pull this in and we look at, okay, well, what are some other strategies? And so you have the average tax rate, but this is the big one, the total taxes. Let's look here. So using the pro rata plan, which is kind of like the base, you're just taking from what you have. Let's go see if there's something better. Well, we have this right here. We have a Roth conversion to the 12% bucket, but remember those IRMA brackets I talked about? You can save a lot of taxes by doing Roth conversions to that first IRMA bucket. So let's select that and see what happens. So from a total tax standpoint, you are still spending quite a bit, 40 grand in taxes early on versus 8-ish in taxes, but you're paying a lot less later in life in taxes. And from a total stat standpoint, you're saving like $1 million in taxes by doing this simple strategy. But again, maybe paying 40,000 taxes early in retirement is not your cup of tea. Let's do one more. Let's go a step up. Let's just do only the 12% bracket. So over the course of your retirement, you're saving, almost 400 grand in taxes, and your net legacy goes up like 600 grand. The other good thing about doing this maybe toned down Roth conversion is that early in retirement, you're only spending 15 grand in taxes versus some of those other strategies that were like 40, 50 grand in taxes, right? So this might be a way that you can avoid the tax bomb by doing these Roth conversions early in your retirement. And as you do those Roth conversions, that means you're moving money out of those pre-tax accounts because those are the ones that will be subject to the RMDs. Oh, really quick, if you learned anything, please like and subscribe. There is another strategy, something that you can do, something called QCDs. These stand for Qualified Charitable Distributions. This is a strategy where you actually are allowed to satisfy your RMD requirement, the amount that you have to take out from your pre-tax retirement accounts, by giving to charity directly from your traditional retirement account. If you are already going to give to charity, this can equate to some serious tax savings depending on your situation. I do have a video linked on the screen that does dive further into this strategy, but many retirees can see thousands saved in taxes per year when implementing a QCD, Qualified Charitable Distribution strategy. That client who I mentioned at the beginning of the video, who was approaching their RMD age, they were unaware of this QCD strategy. So this individual, he knows that he's going to be contributing to a charity anyway. So the strategy makes a ton of sense, will save him some in taxes. Again, every situation is different, but for this individual, it will work. So he can actually even implement this QCD strategy before his RMD age actually hits, if he so desires to. Thanks for watching. If anything was helpful, please like and subscribe. If you or someone you love is ready to take the next step in total wealth management, click the link in the description below. Godspeed and happy planning.